So looking ahead to the week starting February 17th, we've seen a big drop in the euro to multi-year lows. We'll discuss that and whether it continues. There's a big data dump from the UK, and of course we discuss the ongoing effects of the coronavirus on financial markets. Now in the last week, we did see record highs in stock indices, but there were bouts of uncertainty due to the coronavirus, uncertainty about the pace in which the number of cases was going up and down. Again, we'll talk about more about that in just a minute. The movements in FX markets has generally been a push towards the US dollar, and so that dollar strength as a haven has been part of what's been pushing the euro lower. But again, we'll talk about some of those other issues affecting the euro too in just a moment. And understandably, haven assets like gold have been holding up, while oil also suffering from demand destruction from the coronavirus is at a one-year low. Now we'll just look at the economic calendar. Japanese growth heading starkly negative is one to watch. That's more about the sales tax hike that took place in Japan. But with the coronavirus, chances are that as of Q1, we're looking at a technical recession possibly. There's a UK data dump, as I will speak about in just a moment. The unemployment rate expected to hold steady at 3.8%. CPI to rise to 1.5% year over year. Also retail sales and PMIs later in the week. And then last but not least, we've got Eurozone CPI as well to watch. Eurozone inflation, obviously important for that euro picture. Now the euro is dropping down towards 2015 lows against the Swiss franc, 2016 lows for the British pound, 2017 lows against the dollar. And so probing multi-year lows against multi-currencies show that it is a euro-specific effect, not just the weakness in the dollar, although it's worth noting that when the dollar is strong, the euro is the main counter currency, so you can generally expect the euro to be weak in periods of dollar strength. But there are some specific issues. One is that Germany may be facing recession. The economy declined by minus 0.1% in Q3. If we get a similar modest decline again, that marks 2 quarters, albeit of small declines. It's 2 quarters of declines, makes a technical recession in Germany. Obviously manufacturing, and we know all the issues that are taking place there. It's just a bad omen for Europe as an economy and dissuades people from making investments in euro-based investments in Europe, obviously. The other thing being that there were some hopes that the strategic review by Christine Lagarde might result in slightly less accommodative policy, but the recent comments, particularly those to the European Parliament last week, which seemed to be the trigger for those multi-year lows, were pretty much defending the likes of quantitative easing, the likes of negative interest rates, and it seems like those policies are going to remain intact. And the only thing that's going to change, in fact, it's not really a change, it's just going to be the central bank pleading for governments to do their part and do some fiscal spending. So all that put together makes for a very weak euro currency, and from a technical perspective, we're getting a breakdown in the euro after a prolonged range-bound period. And so it could be a false breakout. We could push back into the sideways trading range. But if not, we could be in for a new downtrending period in the euro, which makes for good trading when you have that directional bias. Now there's a data dump out of the UK. I mentioned some of those main data points taking place. This is interesting after UK Chancellor Sajid Javid resigned as the Chancellor last week in the government reshuffle. There's obviously a bias now when you're thinking about the British pound, not just thinking about how the data is currently performing, but of course you're looking forward to the future. You're thinking about these Brexit negotiations, trade negotiations resulting from Brexit with the EU and other places like the United States, and India, for example, has also been mentioned, also possibly even Japan. All those things being considered, but also what does domestic policy look like under Boris Johnson? It's not always a big influencer on currencies, but this might be, and you saw that in the reaction to Sajid Javid quitting as Chancellor, that actually the Boris Johnson government looks like it wants to spend more money. And in the short term at least, that means a higher GDP growth and potentially higher inflation, and just makes the pound perhaps in a better spot, particularly at these low historical levels, as a potential source for where actually the central bank might look to raise rates if the economy outperforms all the others, similar to what's happening in the United States. Last but not least, I just wanted to touch on what's going on with the coronavirus. As I mentioned, there was some ups and downs. It seems like there was an aberration last week where the Chinese changed their methodology for how they looked at the virus. We had a sudden worry that actually the number of deaths and number of cases went up a lot, and maybe the situation was getting out of hand. That combined with more cases overseas. For example, there was one for the first case in London, 15, I believe, at the time of recording in the United States. All that put together was a concern, but actually the bigger picture seems to be that the rate of growth in the number of cases is slowing. And so markets trying to see the light at the end of the tunnel here, that actually there is going to be a hit to growth specifically in China, specifically in industries that rely on China, so luxury goods industries that sell into China, travel that involves a lot of Chinese flights. They're big travelers out of China these days, and surrounding countries. So hence the weakness in the Australian dollar, which I didn't mention, hit decade lows last week against the US dollar. So those areas all expect to be affected, but in terms of the global picture, actually it's going to be a momentary slowdown, which can actually quickly pick up again, particularly with the help of Chinese authorities if they step up the stimulus measures. So all that put together means that maybe stock markets can survive this, and we've maybe seen some of the currency effects already, but maybe they've triggered new trends. These are all things to watch out for, and we'll talk about them in future videos. So if you do like these videos, thanks very much for watching. Please make sure to subscribe on YouTube and social media.